Hello there, YouTube. Welcome to Mom and Pop Know Best. Today, I wanted to touch base again on mortgage rates and refinance rates. So, this is a follow up to an earlier video that we have posted about home refinancing explained. I just wanted to share some kind of thoughts as I'm reviewing mortgage rates almost on a daily basis, and I'm trying to figure out a trend, figure out a pattern, right? You would think that the feds would cut rates, you'll see these mortgage rates plummet, but the opposite is actually happening. And it was something that is very interesting to me, and I don't understand why. So I tried to dissect it and go back, okay, from an economic standpoint, is this intuitive? Does this make intuitive sense? Um, so if you look at it, this was as of Friday, March 20. So the 30-year fixed was at 4.25%, 15-year fixed is at 3.5%, and the APR is 4.326 and 3.6% for the 15-year. So these rates have actually gone up, if I recall correctly, since the last video that I have recorded, which is mind-boggling to me, to be honest, given that the Feds just cut the short-term rates to practically 0%, or a range of 0 to a quarter percent. So that had me struggling a little bit, because a lot of people would think that, okay, your mortgage rates are tied to your short-term interest rates that the Feds just cut, therefore you should see a drop in mortgage rates, but you're seeing the opposite. So what is causing that? So that's something I will try and answer here. But the other thing that I found was very um, funny, if you will, is if you look at the jumbo rates. So jumbo rates, as you can see, are actually at 3.625 for the 30 year, and 15 year is at 3.25. And these typically are where the loan amount is in excess of Fannie Mae's guidance on conforming loans, which is typically about $500,000 or 510,000, something in that neighborhood. Which means that if you're having a larger loan, a bigger loan, if you will, your interest rate is less. While this is not as kind of intuitive, because you would think that these are riskier loans, these loans are riskier loans, but they could, because they're not conforming, they could be done in a separate way. So banks would look at them in a separate way. And there's also the risk premium associated with them. So with that said, why are mortgage rates not dropping? Why do they continue to go up? Well, the simple answer is mortgage rates are actually tied to long-term rates rather than short-term rates, which means that if you want to look at what is happening with mortgage rates, you need to look at the 10-year bonds and see how those, and see the yields on those. So the yield on 10-year bonds is typically what dictates mortgage rates. But mortgage rates, of course, have some premium on top of a 10-year yield. With that said, that premium could vary a lot. So in times such as these, where there is economic uncertainty, your your 10-year yield could be dropping, but the risk premium is going up. Therefore, you're causing now interest rates, or mortgage rates rather, to go higher rather than them to drop with the bond yield, which is quite interesting. Also, if you think about it, banks are assessing risk. So banks are assessing a default premium here. So what is the proportion of these loans that will ultimately default because the economy is not doing as well as it was. And now people may be getting laid off, people may be not able to pay their mortgage. Therefore defaulting on their loans. So they're assessing that sort of risk premium and adding it to the 10-year yield. That causes mortgage rates to actually go up in the near term, but then again, in theory, these mortgage rates should potentially drop, getting closer and closer to the 10-year yield. Um, but again, it is a fascinating thing, and really, I I believe that these rates will sort of continue to be higher as these times of uncertainty continue with this whole illness that is happening now. Once that is resolved, you should see the markets and interest rates and everything starting to calm down, and these times of uncertainty kind of calming down, and your rates getting closer and closer to each other, because that risk premium, which is that gap, if you will get smaller and smaller. And then I just wanted to compare Quicken Loans. So Quicken Loans is actually something similar. So 4.25 to 4.25, and 15-year is 3.125 compared to the 3.25 that we saw here, or 3.5. Sorry, the 3.5 for 15-year. However, Quicken is actually interesting. You can see that their APR is actually a little bit higher, which could mean that they're including points in these rates. So that's something to look out for. If you're ever buying a home and you're looking at which kind of company is giving me the best rate, always try and assess it at the APR level, because what they could be doing is they will tell you, I'm going to give you a 4% interest rate or a 4% mortgage rate, but you're paying a point, which means that they're really giving you a 5% interest rate. So that's something always to kind of look out for, because this is ultimately the APR is is the true cost of that loan. So now, why do I think that these jumbo rates are actually lower? If you think about it, the risk premium on these rates may be lower, although it is a bigger loan or a larger loan, but it means that the houses that are securing these loans are more valuable, are higher in price. And also the credit worthiness of those securing these loans may be a little bit better, as well as their jobs could be higher paying jobs. Therefore, they feel that within times of uncertainty, that the odds of of these borrowers getting laid off is actually slimmer than kind of the regular folk who are getting a conforming loan or a government loan. So that's kind of the way to think about it, but it is quite bizarre. So here the refinance rates are actually a little bit higher in this case. Um, Again, the reason is for purchase rates, they try and be um, a little bit more competitive with their pricing, but refinance rates tend to signal a little bit of uncertainty and a little bit of, okay, I'm refinancing because, let's say it's harder for me to pay my mortgage or something, and I want to try and reduce it. So that's why typically there's a little bit of a higher risk premium associated with a refinance rate. So thank you all so much. Just wanted to share my thoughts here. Also, I have been looking at the Senate bill on the stimulus package of families or individuals and families getting $1,200 per person. Again, nothing final yet. The Senate is still debating this, and they're still working on it. But once something is final, I'll try and post a video explaining what is in the bill, and what that means for you all. Thank you so much, and don't forget to hit that like button and subscribe. And if you have any questions, or you want to let me know your thoughts about mortgage rates and why they're behaving the way they are, you feel free to comment below and let me know what your thoughts are on the stimulus package, and what do you think is happening there, where you think it'll end up, and potentially, um, is it targeting the right things or is it not? So thank you so much. Until next time, take care.